welcome to Property Information Evening. My name is Slesh Chand. I'm a chartered accountant in public practice, and today we'll be doing a special presentation using only limited slides and focusing on chats and discussions about what's happening in the economy. To be honest, I think there are four major issues impacting Kiwis: interest rates, shifting global issues, such as your US tariffs, the Iran oil war, and our election this year. Those are the major four issues that's going to impact us over the next 12 months. We will try to make the next couple of hours exciting for you. Hopefully, it'll be just an hour, depending on how many questions we get from you. Please feel free to ask questions by typing your questions in the space below, and we'll try and answer them throughout the presentation. Before I move any further, I just want to make it clear that Then and I are not financial advisors. We don't give any sort of financial advice. So if you need financial advice, you can talk to someone like Chris Peterson or a financial advisor. Um, I'll give you about 2 seconds to read the slide before we'll move on. And if you've got any questions about that, please email us. So just a big bit of background about me, who I am. So as I mentioned, I'm a chartered accountant in public practice. I'm a partner here at GRA. I currently have 16 years of experience in property and business accounting. I'm also an active property investor, so I buy and hold on to properties. Currently, in our portfolio, we have just over 60 properties we are holding on to, and most of these properties are long-term holds, cash flow positive and land bankings. And if we subdivided these properties, we'll have about 300 sections to build on. But we're not doing that. We're holding on to our assets. And we've bought a couple of new properties this week as well, and we've settled them. Hopefully, we'll get a chance to talk about that later on. So that's a quick background of who I am and what I do. This is my current portfolio. In 2007, I was broke, and basically I had no money, 47K of debt, and I started investing into properties. I met Chris Peterson in 2007. That's how far back Chris and I go. In 2010, I bought my first property, and here in 2026, we have over $50 million in our property portfolio. And I can tell you this now, Chris does most of our banking. He'll also tell you that it's quite a rich portfolio. We have a lot of cash available in our portfolio. We have a lot of properties and cash flow positive and land banking. So I just don't talk the talk. I actually walk the talk as well. And that's one of my skills here. I know a lot about properties and I know a lot about finance, but I still get Chris to help me with funding and things like that. Now, guys, if you do need an appointment with us, or if you need anything from GRA, or like regarding today's presentation, anything like that, please get hold of Amy, or you can scan the QR code and fill out our forms. And this is Chris's details here. So if you need to meet with Chris, he's a good man. He understands banking and very knowledgeable guy, well connected to the banks. So feel free to get hold of Chris and organize a meeting time with him if you need to. But we'll bring the slides back up shortly. So just a quick introduction to who Chris is and what he's done, and what he does for us and our clients. Chris is the founder of Chris Peterson Mortgages, or KPM. You hear him out promoting KPM all the time. Bunch of really good mortgage brokers. They do award-winning mortgage advice, so fantastic with the mortgage products and the structures they can come up with. Top-ranking advisors, totally agree. I not only work with Chris, I work with the rest of his team as well on clients they're bringing across to us to help them with restructure and things like that. And Chris can also do specialist lending for your clients as well. This is your second tier lenders and things like that. And he's also a financial advisor. So he doesn't need to follow the disclaimer. I need to follow the disclaimer, so he can say whatever he wants, whereas I can't. And then we've got and he can get sued for that. And
Thanks, man. Love your work.
and I'm not a financial advisor, so I get to see whatever I want. That's my advantage here. But then on the other side, he's one of our property gurus. He's actually does a lot of work with me. Then and I probably talk 10 times a day. He's out on the field every day doing looking for properties, doing building houses with the contractors, keeping an eye on site, project management all the way from start till end. He's an experienced property trader. He does renovation, buy and hold or buy and sell. He does renovation for that. He looks for margins and he brings me deals But what we've realized in the last few weeks, we've been actually quite busy building houses. So we haven't really focused on trading much properties at the moment. And Then does a lot of market value assessment, and which he's good at. And I send him property deals, and nine out of 10, he'll tell me not to go ahead because he can analyze risk or the market value. Now, we're going to have a frank discussion here. So, shortly, we're going to be off slides, but this is the 5 topics we're going to talk about today. We're going to talk about interest rates, especially with the war and the oil crisis we've got, lending, how lenders are responding to the market volatility, managing risk, protecting your position. So, very important. How do you protect your position if something goes wrong? Because we could have a recession come through, and we have to work out how we're going to protect ourselves. What we're going to also talk about is property market, what types of assets are moving, what type of assets are not, and trading property. So Then's going to talk about that, and he'll guide us through the process. There you go, guys. And now I'm going to take over then. Chris, are you good to go? Can I throw some
Good, mate.
questions at you? So the way we're going to run this presentation, I'm going to start throwing questions at Chris, which I've thought about it throughout the day, and I've run this question past Chris, and he likes them, hopefully. Chris, we got mum and dad investors, property investors, and business owners here today. We've got a full house. All of them are concerned about interest rate, especially around the Reserve Bank reducing interest rate aggressively through 2024 to 25, mortgage rates coming off their peak, right? Inflation was 3.1% for December 2025 and is forecasted to hit 4.2% by June 2026. That's next month, driven partly by the Middle East oil shock. The Reserve Bank is now expected to start hiking interest rates as early as December 2026. Chris, please give us your view on this, and should we be worried?
Thanks, Al. And as a starting point, I just want to say Salish is a master at getting people out of sticky situations and likes doing that for his clients, but I'd rather not get sued. So if I can just basically say that this is general advice for everyone as well before I start getting into some detail. So as Sal said, and I suppose if I just expand on that, if we kind of go back circa 6 months ago, we were probably in an environment where interest rates were still dropping. The Reserve Bank in November last year cut the cash rate from 2.5 down to 2.25. And then a couple of weeks after, the inflation numbers came out, as Sal said, at 3.1%. And keep in mind the Reserve Bank's mandate with inflation is to stay between 1% and 3%. And that's something just to keep in mind, because once you start getting above 3%, that's when they start about nudging interest rates up. And as Sal then said, of course, I suppose since then we've had the whole Iran situation, which has basically meant that they have come out with a projection for, I think, the coming month or the coming quarter, basically, of inflation going up to 4.2%, which is well basically above their mandate. And we've obviously had this oil shock, which has basically come through, and the Reserve Bank can look through singular events when they're basically, I suppose, looking at how to handle inflation. So if I do a comparison and go back to 2021, when we had locked borders, what happened is we ended up with wage inflation. So basically what happened is we had locked borders, couldn't get enough people into the country. So basically a lot of employees started demanding basically more income because they could bounce between employers. In that case, that very quickly caused inflation. So the Reserve Bank reacted by basically ratcheting interest rates up very quickly. In this situation here, this is a supply issue. The lack of supply of oil coming in isn't something that we fix basically by ratcheting interest rates up. So what they do is they're looking at this as a two-stage process. So if we look at this, I suppose stage one, if we throw basically a pebble into a pond, you have the initial rupture of the pond, and that's stage one. And so effectively what happened is petrol prices went ratcheting up. And so that on average was an increase of about $55 per week for the average family. Painful. There's people coming out of like cost of living crisis, all this type of stuff. But the hope, I suppose, initially is that doesn't get spread on to the rest of the economy. Stage two is where the Reserve Bank will look at ratcheting interest rates up and look at doing it quite quickly. So stage two is looking at things like, again, as I just mentioned, a wage spiral. So that might be a case of staff members who are suddenly having to pay their additional $55 at the pump each week to fill their car up. They're suddenly going to their bosses and saying, hey, we need more money in our pocket to live. Boss relents. And then what happens is the boss sits there and goes, hey, I'm getting squeezed. And they start pushing the basic price of their goods and services basically up as well. And that basically starts causing inflation. So there's other events as well where when inflation starts getting inbuilt, which is something that the Reserve Bank would be very concerned about, is when people start to think that the cost of things is going to go up, so they start to react almost in front of it. So what can happen is people go, okay, things are going to be more expensive in the future, so I'm better to buy them now. And that actually can react by pushing prices up over time. So I'm not going to say that this is going to happen in New Zealand at all, but because it won't, we've got much better economic management. But I suppose a real extreme version of when this happened was I remember talking to a customer of mine, would have actually been kind of roughly around the time I met Salesh. And this guy had been a Zimbabwean farmer. He'd been really rich over in Zimbabwe. And he'd come over and he told me he was a bit of a golfer. And what happened there is the inflation was basically so rampant that basically they would have the beers before the golf game because the cost of the beers had doubled by the end of the day. And so in Zimbabwe, when inflation got out of control, to give you an idea, basically they got to a stage where they got up to $80 billion to 80 billion% of inflation in a single month. And so, as an example, because of how they were not handling it, basically you get a loaf of bread for $1 back in 2000. By 2008, that was basically costing $10 billion for the same loaf of bread. So the money was basically worthless. And so this kind of results in basically things, and this is obviously an extreme case, where workers were having to be paid daily and they were immediately spending their money because basically their money was almost worth a lot less by the end of the day. So again, New Zealand's not going to end up in that extreme situation. But if we kind of tie that back, these are the kind of concerns the Reserve Bank has when they start to see certain kind of behaviours behind the scenes. Now, bottom line, I suppose, in regards to that is the Reserve Bank will be hoping that the Iran shock and the ceasefire basically stays in place and that the first round event, the rock going into the puddle, basically stays there and doesn't expand. And basically, hopefully the strait basically reopens and that's it. But if the second round effects basically starts taking hold, wage spiraling, costs going up, and all of that type of situation, the Reserve Bank will act no matter what, even though that will create a lot of economic pain. Now, getting that call wrong is effectively what caused the 2021 and 22 inflation spike. And that's what we ended up having to have that absolutely rampant interest rates going through the roof back in 2022. So they want to avoid that again because they got some pretty bad egg on their faces and reputational damage. Now, if we look at that also a little bit further, so you've got the Reserve Bank, whose job is to try and control inflation, sorry. And so they use interest rates and the cash rate to do so. And then we've got Treasury, which basically provide the government fiscal advice in regards to how to basically manage their budget. So Nicola Willis, the finance minister, had asked Treasury to come out with some scenarios. And so this was like 3 cases. Best case was roughly what we're looking at now, where the cost of oil was around $110 a barrel. I think what I saw yesterday, it's about 105. And that would still basically mean that we get higher inflation. The worst case is basically the cost of oil will go up to about $180 and inflation would literally be going through the roof. We would end up with unemployment rates spiking and things like this. So even the best case scenario at the moment is going to push inflation up. Hopefully the Reserve Bank will look through that as much as possible and not hike interest rates too much. If this goes on, and when it goes on, say goes on well into basically this year, they're going to have to look at hiking interest rates because we will start to see other basically flow-on effects basically play through. Now, the next, I suppose, quick concern on that is stagflation. So stagflation, if we go back to what happened in 21, we actually had really strong economic growth. Basically, people were feeling richer overall, but basically what we ended up with wage inflation, all that kind of coming through. So we had economic growth and basically, I suppose, wage inflation and inflation at the same stage. So the Reserve Bank had to create a recession to slow everything down and temper inflation. The biggest concern for policymakers is when you've got rampant inflation, so basically price of things going up, but you've got very slow or negative basically economic growth going on, because it's very hard to use policy tools to control that. If you increase interest rates to fight the inflation, you crush the economy and you cause a huge amount of job loss. And there's probably, I think, well, I was talking to Salesh and Dan about this behind the scenes earlier on today. we're already having phone calls from business owners and stuff like that who their phones aren't ringing as much as probably what they were at the start of the year because of this effect. But if you cut interest rates to stimulate the growth, inflation goes through the roof. And if you think about what I said about Zimbabwe, no one wants to live in that situation there. So, in regards to the stagflation situation, it's a hell of a mess to try and monitor. We're already in a very minor version of stagflation. At the moment, the New Zealand economy is not fantastic. Our agri market and that's good, but we're not definitely going off at the moment. But everything really centers on the Strait of Hormuz. If the ceasefire holds and we basically manage to get out of the worst of it, then okay, we'll be feeling pretty good. But if this risk rises quickly, and basically we're still looking at this basically at the end of the year going into next year, the Reserve Bank and the people who make the big calls is probably the hardest policy call to basically make in a generation. So we're kind of looking at these situations over time, trying to figure out where interest rates are going to go is going to be very, very tied back to what's happening on Iran.
Thanks for that, Chris. Um, what are you seeing regarding how people are handling their mortgages? What strategies are you intending to recommend? Like, for example, fixed short-term or long-term interest for, basically investors, mom and dads, or business owners? What are you recommending?
So we're getting a real mix. So prior to the Iran situation, we had been leaning towards probably a lot of kind of 2-year rates and stuff like this. I still kind of was under the impression, talking to a lot of people, like from customers, but also economists and all this kind of behind the scenes. To me, I didn't think this was going to be the same property cycle we'd seen previously, where things just took off out of control. Like I've been with Sal previously, where we saw rampant property prices back in the 2000s. Most people listening would have seen property prices go mental through COVID and stuff like this. I definitely didn't have the impression over the last 12 months, even though the market was picking up, it was going to be another crazy property cycle, if that made sense. So to me, while there'd been some concerns about inflation, I didn't think we had to have the same aggressive rate increases. But what this Iran situation has done is because of the dynamics I mentioned before, is thrown in a huge amount of confusion because we don't know whether we're sitting here with option A, which means this is over and done within a few months, or the other situation where interest rates may have to be ratcheted up because it's a prolonged situation which drags on for years. And so for me, I suppose in most cases, we're sitting there saying maybe consider hedging over multiple terms. Uh, I'm not really a big fan of sitting there right now, probably fixing for short-term rates, unless you're looking to sell or you're coming. I was talking to a client yesterday who was coming into an inheritance. So he's like, I don't need to fix for any longer. I'll fix for this time. I'll get money at the end of the year, then I can pay my mortgage off. I'm done. So we're kind of getting a mix of people going, okay, especially if you're carrying quite a bit of mortgage debt, consider hedging over multiple different terms. You may kind of pay more overall rather than just looking at, but because we've got so much uncertainty and we don't know how this plays out, that acts as a protective measure rather than having everything come off at the same time.
Well,
Chris,
I personally, sorry, then go
sorry,
for it.
D- Chris, do you see a lot of people coming wanting to break their current loan and fix for longer terms?
Yeah, great question, then. Yep. So that's definitely something we're getting quite a bit of recently with people going, my mortgages might be coming off in, let's call it August, September.
Mm.
Everything right now basically is showing interest rates going up in the short term. Maybe what I might do is pay a break fee now and just lock it in now for a bit of additional security. So we do what we call a break fee analysis, where we go. If there is a break fee, we get that fee from the bank. We try and basically analyze, okay, what's the cost going to be basically from say now through to your rate expiry, plus the break fee, and we can basically do some analysis there. It's what happens basically down the track, which is crystal ball gazing, and I'm not a geopolitical expert, so I can only make a comment on interest rates, not much more besides that.
Come on, mate, you're a rocket scientist. We know that. Now, just personally, because I've got a big, portfolio and I deal with bankers every day. I deal with five different commercial bankers on a daily basis. I am fixing mine for 3 years. I'm getting 5.3 for 3 years and I'm taking it. Especially the ones that are even coming off fix in the next 2 or 3 months. I'm breaking them now because I'm fixing them because I want to hold on to these properties. I don't want to sell them. So I'm fixing them. That's just my personal view. I'm not a financial advisor. Um,
Yeah, I definitely think the majority of our fixing has been kind of in that midterm situation.
mm,
As I said, I need to make sure I can't make any comment on how long this war goes on for, the effects for it, how interest rates play out, all that type of stuff. But for me,
yeah.
the majority we've been looking at is that 2 to 3 year space going
Mm,
that provides a good level of certainty. And a lot of touch wood, fingers crossed, hoping it's over and done with basically by the end of it. There's a part of me I'm concerned about if we fix clients for too long, like taking the ultra cautious view of going out there and fixing for 4 or 5 years. And could we end up in a situation where rates fall? Now, I'm I need to dig into this more, but I suppose one of them, I'll throw this out to both you and Than. I mean,
mm,
for me, one of the things, if we go back to what we saw at the start of the year, was where we saw there was business confidence coming back, the economy was growing, and because of that, we had the high inflation, which was meaning the Reserve Bank was thinking they were going to have to ratchet up interest rates. Would you both agree that we've already seen a whole lot of business confidence lost in the last couple of months?
Oh, definitely.
yeah.
So for me,
Def,
there's a part of me, and I want to be very careful with everyone on this. Don't take this as advice, but there's a part of me I do wonder if what could happen is um, the New Zealand economy is pretty fragile overall. So, and talking to real estate agents, there's not as many people in auction rooms, all this type of basically situation overall. Is could we have a situation where what's happened has literally killed a lot of the business confidence already and basically stifled growth? If the ceasefire basically eventuates for the sake of it, could that actually remove some of the inflationary pressure? Because we're not talking about overseas events and the inflation issue, but that damage to the economy has still been done, if that makes sense. So you've still got businesses being wobbled, you've still got people who are scared, so the economy doesn't go through the same growth. Does that mean that potentially they have to pull interest rates down more, if that makes sense, to re-stimulate? Because I go back to what I said at the start, we're only back in November when they were talking about further cuts to the cash rate. Huh?
mm,
And we're right back now thinking, like, to me, the mood in the economy is a lot worse than what it was at any time last year.
mm,
So
yep.
so I'd just say to everyone, be careful on that. There's a very good chance what I've said does not happen because inflation could get more entrenched. But what I'm looking at is that at the same stage, I don't know if I want to be fixing all my mortgage rates now for five years,
Mm.
because you might be fixing for a long period of time, come out, and then you might have significant break fees to get out of those rates.
Yep. And we've seen that previously as well. Um, I'm going to jump on to topic 2 here, our bank lending side of things, Chris. Again, I've got questions for you. How are the banks behaving right now? Like, are they loosening or tightening? What is the mood inside credit departments when you have this global uncertainty and is elevated? So, you know, what are they behaving like? Is there specific, roles or jobs they look at and go, we're not going to fund them? Like, what's happening?
Yeah, great question. So kind of overall, I wouldn't say we've had much of a directive from the banks in regards to concern. I think overall, on the whole, we're kind of seeing business as normal as we were, say a few months ago before the Iran situation basically happened. If anything, I think overall the banks have definitely been lifting their appetites, and that's basically shown by the volumes kind of flowing through. Most of us here are property investors and stuff like this, and the amount they've been lending into the investment space has been increasing like considerably kind of over time. We've been seeing little kind of tweaks around the edges where that's been designed to enable the banks to actually lend more. I wouldn't say I've seen too much kind of pulling back of lending kind of criteria overall. Um, I will sit there though to answer a point that I think you made, Sal, which is pertinent. There's definitely certain industries which they have high level of concern on. And so things like the construction industry, basically I think it's had the highest amount of liquidations over any industry basically kind of going around. I look at even things like real estate agents. We've had a couple of cases where, you know, real estate commissions basically can be quite volatile. We've seen basically people's income go down a lot over in the real estate space, say over the 23, 24 year basic, years when things were hard, maybe pick up at the last year, but maybe pull back a bit, kind of going off some of the feedback we're having from agents. Banks are aware of this. They talk to a lot of people behind the scenes. And so if they sit there and go, okay, you've had a bad, 23, 24, you maybe kind of bounce back a bit in 25 and 26, but they might sit there and go, you've had one good year in the last 4. They might be a little bit wary if that makes sense. So they're going to ask more questions. So to just be aware if you're in one of those industries where you've had a lot of volatility, they're gonna dig into your situation.
Yeah. So you better run your books clean.
Yep.
Yeah. Okay. So I've also got debt to income restrictions. They are the new constraint for borrowers. Is DTI really in place? Even if rates fall, like debt to income restrictions cap how much people can borrow. Please explain how DTI impacts the everyday borrower. Like I heard about DTI. Personally, I don't think about it, but now and then it pops up. Is it really in place? Are the banks using it?
So firstly, just to explain kind of debt to incomes or DTIs for those who maybe aren't aware what they are. So debt to incomes are a tool that have been used overseas, and they're a tool that the Reserve Bank, who effectively regulates all our banks, have been fighting for a number of years. And previous Finance Minister Grant Robinson. So the Finance Minister basically has to give the Reserve Bank more tools. So Grant Robinson gave Adrian Orr basically access to DTIs, and they were effectively introduced back in July 24 by the Reserve Bank. And high level, the rules were that the banks can only lend a maximum of 6 times a household's gross income to buy an owner-occupied property, or 7 times a household's gross income, so that includes potentially rent, to buy an investment property. Now, the banks are allowed to do 20% of new lending outside those thresholds that I basically just mentioned as well. Now, to answer basically what Sal's saying, because we've been kind of keeping an eye on this for a long time, banks run their own loan affordability checks. And I won't get into that too much at the moment, but one of the things we've been watching, because ever since I've been in business, we've ran affordability checks while we're talking to clients to see what their borrowing capacity is. So we've now got a whole nother mechanism what the banks have to abide by. It's a regulatory tool. So we've been kind of looking at this, and the reason you haven't heard too much about DTI, Sal, is that the bank's own affordability mechanisms so far have been more stringent than the DTI rules. Okay. Now, I think probably the bottom line is that DTI rules are probably in place for a long-term point of view. So they are going to be consequential, but they're more probably acting as a speed limiter for the next boom rather than a kind of a massive break on the current market. So keep in mind, if we look at probably what was happening overall, I would sit there and say that we would have been talking about DTIs this year if, for example, the Iran situation hadn't happened and slowed the property market down. We would have started butting into that in some stage. It's going to come into place a lot more on a regional aspect. So you'll find that parts of New Zealand, such as kind of Invercargill, in places like Taranaki, the housing there's a lot more affordable. So for the average client, they're probably not likely to be talking about debt to incomes as much. If you look at Queenstown, on average, probably their houses are seen to be a lot less affordable. Having said that, I don't know if the Queenstown market will get affected, because I think so many of the people buying there are wealthy expats. Sal and I were involved in getting finance for a guy who's very wealthy, who lives in Australia, who bought a $10 million home. DTIs aren't going to affect him, if that makes sense, and he's not the regular borrower. And I think Queenstown, what's propping that up is not the average Kiwi. I do think DTIs, though, might affect more, say, things like the Auckland market, the Wellington market, those main centres moving forward. And so I just don't think we're going to see the same growth in there as what you'll see in some of the regions where the cash flow looks a lot better.
And then you've got the LVR rules. So investors still need, I think, 35% deposit for existing properties and 20% for new builds. And are these LVRs still in place, or you can get us property investors a better LVR ratio, Chris?
Yeah, so a couple of things there. So you said 35% of, so 35% you were talking about the deposit amount,
Yes.
which would mean 65% lending. It's actually 70% in most cases for existing properties. While in most cases we would see, so when we talk about new builds, the banks don't actually have constraints on new builds. They're exempt in regards to the loan to value rules. So the banks in some cases are doing 90% lending on new builds investments because they don't have those same constraints. So without getting too technical, in most cases, you're going to see investment lending for existing property limited to 70%. But a change we saw back end of last year by the Reserve Bank, and I think in some ways this is them tinkering but behind the scenes. They've putting in a DTI on one side, but they're pulling another lever over here and relaxing the LVR rules. And what they, up to that stage, they really weren't allowing any lending outside of their rules. So that they were capped at 70%. The technical rule was that they could do the banks could do 5% of their lending outside that. The banks didn't even bother. It was too much of an admin nightmare to try and do anything. What we've seen is one bank come out, and because the Reserve Bank late last year changed that exemption from 5% to 10%, so just to explain that again, so banks were limited to 70% on what they could lend, but they were allowed to do up to 10% of their lending above that 70% threshold. We've had one bank basically come out and allow clients to go to 80% in certain circumstances. Now they're putting rules around this. What we've found is they're still kind of juggling the best way to handle it. In most cases, the clients have to have very strong affordability. But we've been doing at KPM, we've been doing a huge amount of rejigging behind the scenes, where what we've been doing is going, okay, if we can get you 80, let's move all your investment debt to 80, pull the money back into your home. And this is where we play games with Sal and his team all the time, where we separate banking. It's a great chance to get equity back into your home and get into a better position.
And you also get interest deductibility, you know. Interest deductibility is so important. I'll just quickly explain what that means. Like, let's say you pay $100 of interest and you get no deductibility. So you pay $100 to the bank, your $100 is gone. When you get deductibility, that means you get your tax back on the interest. So for example, if you pay $100 in interest cost and your tax rate's 39%, you get $39 tax advantage immediately. So that means now the interest has cost you $61 instead of $100. So that's what interest deductibility means, and something that Chris and I focus on that when we help clients restructure their mortgages and we look at ways of getting deductibility. Now, Chris, I understand there's also some products around self-employed and complex income borrowers as well. You've got some good products out there, and especially for business people who are looking at buying their own premises. You know, is there something in the market for them? I understand there is, but I'm just double checking.
Yeah, so firstly, I suppose jumping in and talking about self-employed clients, because I suppose we've just finished the end of the financial year recently, and it's something which at KPM we work very closely with GRA is keep in mind that we have just gone through a hard few years, and so there's a lot of people who their business and their revenues bounce up and down, and so banks are asking a lot of questions. And so one of the things I'd sit there and say is if we're looking to probably get finance in the next while, part one, you want to make sure pretty much everyone's using something like Xero these days. You want to make sure your Xero's up to date. You want to make sure that because a bank's almost always going to be asking to cite things like your profit and loss and balance sheet, and so you need to be providing that accurately to the bank. If you've gone through a hard few years and maybe only the most recent financial year, so up to March 31 was good, they're going to probably want to be more than management statements. They might be wanting drafts or probably finals. And this is where I'll give a big plug to GRA, because we have issues often where clients find a property, and then they have to run to their accountant, and often their accountant can't turn books around in time, and they'll basically kill the client's ability to get the deal. So especially if you're already like a GRA client, they're very, very fast. They've got a fantastic team in regards to basically kind of getting things through to drafts, through to finals. Me and Sal, I popped over to Newmarket today. We had two different clients in between discussing tonight's event who have got settlements or basically deals they're wanting to go unconditional on, where we're basically working between our terms trying to get, Sal's trying to get his team to get finals through. I'm basically then trying to get that pushed through to the bank so we can get things done quickly. I wouldn't even bother with a lot of other accountants because I just know they wouldn't get it done in time. But I'll sit there and say Sal and his team will bend over backwards in most cases to basically do that. But make sure if you're in the position of wanting to get finance, that you do what you can to enable his team to be able to get that across the line. As a couple of quick examples, and it's a mutual client between GRA and KPM. But a client basically go unconditional on a property a while ago, but they didn't have any of their financials ready. We had to do a two-stage process of non-banking them. So that was taken into a lender who didn't care about or wasn't that concerned about the income side, and then wait for them to provide everything through to GRA so we could then basically get them to bank. That basically meant the client unnecessarily had to basically burn about 20K in additional financing fees. So just make sure if you're out there looking to buy that you basically kind of get in front of your financing and stuff like that.
Yeah. And we also have a team of about 10 accountants who work on agent books for banking purposes. So that's one of our advantage, and they're literally working the weekends if they need to get the books out for the clients. And this is really important because every week we're probably doing 2 or 3 settlements. Chris had needed the books done urgently, so it's getting done out the door. And obviously we are chartered accountants, so what we do and gets reviewed and signed off by me as well. So the banks liked it. They like
So
the
just
quality we produce.
sorry, Sal. So just to kind of expand and a little bit more, sorry, what Sal was talking about, more complex lending. And the way that we'll look at clients these days is, so a small client might walk into the office, they might want to be buying their first home, they might be trying to get their first or second investment property. That person tends, in most cases, fall into, say, what we call retail banking. Let's say that clients may be trying to buy their fifth property or something like that, or they maybe be the owner of a small to medium business. They then kind of more fit into business banking. Now, retail banking is very tick box. It's more and more these days being driven by systems. There's very little people contact. The staff behind it don't have much autonomy. Business banking is a little bit better than that, but again, quite tick box. But more and more, there's a lot of clients we deal with who, and it tends to be GRA and KPM, we deal with clients who might be higher net worth, have larger property portfolios, have a bit more complexity. And so, for example, quite often clients who are higher earning, we deal with a lot of clients and we'll position them at what we call private bank. Now, different banks have different criteria to go into private bank, but these are bankers who have more autonomy, they can make more decisions, they will understand that the bank wants to look after clients who are earning good money because they can, from their point of view, they can hopefully make money out of them. And then I suppose there's a lot of people out there who are large property investors, and they're the clients that we've dealt with for a long time who are finding the bank market quite difficult at the moment. So for a long time, what we would do at KPM, if you're a large property investor and maybe your income outside property investment wasn't that high, we'd try and keep you away from commercial banking because occasionally the commercial banking costs were higher. Often they do want to try and they're not as happy with you split banking and things like this. What we've been doing more recently as the retail and business banking parts get more and more structured, more driven by technology, more and more tick box, is we're finding that the bankers at the commercial banking side are becoming better and better. And this is very, very much relationship based where myself, Ryan, a business partner, other members of our team, we will spend a lot of time trying to build relationships with bankers who actually have the ability to think. They've got sign-off, like credit sign-offs, where they can actually make decisions which sit outside standard criteria. And so what we're finding is that we've got these larger investors who are finding it harder and harder to get money at bank level because they're running into brick walls. So what we're doing now, if we can't get them through those divisions, we're working on developing better commercial banking relationships. Now, keep in mind, you may not always get the exact same pricing as what you're basically used to at retail, but if you're wanting to basically kind of keep bringing on properties, this might be something you're having to do to move forward. And we're basically kind of working with those bankers there. And they will look at things quite differently, where a retailer or a business banker will look at an assessment, including basically what you spent on McDonald's and your personal expenditure and stuff like this. A commercial banker will disregard all that and look at the property portfolio which sits with them, and they'll work on what we kind of call interest cover, basically formula. They're not really concerned about your personal expenditures side of things. So if you're kind of one of those people who are running a larger portfolio and you're finding you're running into brick walls, keep in mind that might be where you need to look. For those of you who are into brick walls at retail, just not without being rude, if you've only got a couple of properties and stuff like that, they're not going to let you into commercial. You've got to get to a larger size before you can kind of get in there. If you're not fitting any of those kind of categories I basically just mentioned, that's when we're using non-bank lenders. And the non-bank market's kind of getting larger and larger. There's been some changes there. There's been a deposit scheme that was put in place, I think, last year, where effectively for the companies which have basically entered in, if you put your money into the finance companies, you're getting effectively 100% guarantee, I think, on the first $100,000 that you put into it. So there's suddenly a huge amount of money going into these finance companies, because you can put money into a bank and get a low interest rate, or you can put money into a finance company and get a much higher rate, and you've got an insurance guarantee on it. So that's attracting a lot of capital, and so we're seeing basically those companies go up in size quite quickly. There's another thing called securitization, where what the banks, and they've been doing this for years, they were doing this right back before the global financial crisis, where what they do is they provide, if you can imagine, a large revolving credit facility, it's called a warehouse, to a non-bank lender. So it's a bank, so let's say Westpac, because they do a lot of this in New Zealand. They provide a non-bank lender a facility. That non-bank lender basically lends that money out, and those non-bank lenders are doing all kind of crazy things that the banks don't do. So they're approving huge amounts of loans all over the place. So a huge amount of the non-bank money in New Zealand is actually coming from the banks. Now, I was talking to the managing director of a non-bank today, going, why is the size of the non-bank market in New Zealand so small in comparison to Australia? Because that warehouse securitization model, what they do is they fill up the warehouse, and they do a process called securitization, where they sell it basically out to things like ACC and super funds and stuff like that. That replenishes, and they basically go through the process again. And the market for that in Australia, if we basically obviously understand Australia is quite a larger country to New Zealand. So if we said we were the same size, that market is somewhere between 40 and 80 times the size of what we do in New Zealand. Now, the reason why it's so much larger is here, basically banks have to hold a lot more capital when they're lending, or that's basically, if I can compare that to being like a property investor, when we're putting deposits in to buy property, that's like putting how much capital we have to put in, if that makes sense. Now, in New Zealand, the banks can leverage a lot when they're lending to me or you. When they lend basically out to a non-bank, they don't get that same kind of leverage, which basically means that when the non-bank basically lends the money out to you as an investor, they've got to charge a much higher interest rate because they're not getting the same leverage overall. Hopefully that makes sense. In Australia, what happens, they get a huge amount, much more leverage. So almost basically the bank gets the same leverage as if they're lending to the customer direct, or if they're lending to the non-bank and the non-bank on lends. And it sounds like there's a lot of discussions going on at the moment with the regulators behind the scenes that basically that should be coming into New Zealand, hopefully in the next 12, 24 months. What should happen on the back of that? The non-bank interest rates get a lot closer to bank. Okay. So if we look at basically New Zealand market and Australian market, they do a hell of a lot more non-bank lending over there than what we do here, because there's such a price differential overall. So that market's going to grow substantially over time. We're always going to sit there and say, basically, take your money from banks first, but more and more moving forward, because of how things are regulated, if you fall outside the bank spot, there's going to be a lot more solutions basically kind of coming in.
And Chris, you also can do long term, right? You don't have to do a 2-year term. You can do 10, 15, 30-year terms with.
Yeah. I mean, the guy who I was talking to and stuff like this, and he's got a great product. And for any of you who are sitting there with non-bank mortgages at the moment, I would say to think about this, where what this guy's tried to do is basically bring a product to market, and it's a refinance product. You can't borrow anything more on it, but it's designed to smash up the non-bank pricing. So what he's basically doing is saying, okay, and pretty much what we've had to do is provide an application form, 3 months mortgage history, copy of ID, and I think the loan to value ratio has got to be 65% and under. They'll run a credit check on you, so that credit check's got to be clean overall. They've got their own stuff they'll look at. But if you're ticking those boxes, in most cases, what they will do is basically beat the interest rate you're at with other non-banks. So I'm working on a client at the moment. And in most cases, we should get her 1.5% interest rate savings, so kind of across the board from mortgages we're moving across. Where this becomes exciting is for any of you who have got developers and have got maybe residual stock, especially with the property market slowing down. You may have had a situation where you bought your development, plan to on sell, market's got slow, and maybe what you want to do is hold for a period of time. But if you're with a non-bank financier where often they're only offering you 12-month mortgage terms, you might be about to get stung with another massive fee, if that makes sense. As Sal just basically correctly said, this lender here, yes, they got a fee. It's a lot less than what you'll probably get charged elsewhere, but they can effectively give you a 25-year term at very cheap non-bank rates.
And I suggest, if anyone is wanting to look into this further, they should get hold of Chris because this is amazing product, and long term as well. There's already second tier lenders that are out there doing 25-year term loans. So pop around, see Chris, see what he can do for you. Now, I understand, Then, you got some questions for us, which is going to be our topic number 3, managing risk in uncertain times. So Then's drafted some questions for us. So hopefully now Chris and I can answer some questions for Then. Then, what have you got for us?
Yeah, because I mean, we're talking about borrowing money, interest rates, investing in property. This is a lot of money. So risk is something that, a lot of people want to get involved in knowing what are the risks. So in your eyes, managing risk, what does it mean by actually in practice?
So I would say I have well over probably about 20 companies, and I know in some cases I can borrow up to 10 to 15 million at a time, and I do my borrowing, and then I do my developments or buy to hold or
Mm,
whatever I'm doing on the day. Now the first thing I do is to mitigate my risk so that nothing goes wrong for the rest of my portfolios is that I put a separate company in. I have a separate company for my whole properties owned by a different trust, and then I have a separate company for each development owned by a different trust. Now, if I have something go wrong in one of the companies, I don't want it affecting the rest of my portfolio. So the first thing I do is to mitigate risk, is to put the right structure in place. And something that I do for myself, I do it for clients. And you got to remember, I've been, looking after clients for 19 years now. And I've set up a lot of structures, and 95% of my clients are multimillionaires. So I understand structures. And I will tell you this, that most staff at GRA, they get it. They get structures are really important. Now, some of the other things I do to manage risk is not all just about having insurance, right? You've also got to have your cash buffers. Like this is your overdraft facilities and things like that. You've got to have that in place because in the event you run out of money, you want to be able to go into your overdraft facility or offset account and access that fund. And Chris is your important man to get you all these facilities. That's what his job is, to go and put all these facilities in place. We also look at a debt restructure. Every money that I borrow, I want to get my 39% back on my tax. So I gave you an example of paying $100 in interest. If you get it non-deductible, you pay $100 in interest. Too bad, it's gone. Whereas I pay $100 in interest and I get $39 back, and that's what I like about interest deductibility. So that's also, I look at mitigating my risk, managing my cash flow risk is getting deductibility. If I'm looking at long-term holds, I look at tenant quality. I like good tenants. I like my rent getting paid. And that's why I've done 17 years of social housing now, and all my properties are rented to social housing providers, I think, except for one. And, I've always supported social housing. I've built houses for social housing. Then you help me build houses for social housing. You've seen the impact we make. We provide good housing and we sign up long-term contracts. Um, Also, the kind of properties that you buy, you got to mitigate your risk by what you buy. You can't just go and buy a property that is in a flood zone. You're not going to get insurance on the property, which means you can't get any borrowing on it. So you've got to be very careful what properties you buy, and you get the insurance company to check it before even your finance. Chris, am I right? You can't draw your finance down if you don't have insurance on the property.
Correct. Yeah.
Yeah, because that's a requirement, isn't it? A funding requirement. You must get insurance. So when Chris gets your unconditional offer, don't think you can go out and buy the property and the banks will let you draw the loan down. You must check if you can get insurance or not before going unconditional. And you also got to know your exit options. Like, what do you do if something goes wrong? right? And there's no harm in selling. What you got to remember is, people get too attached to their property. They don't want to sell. You can sell and buy tomorrow. It's okay. I've done this. I've sold properties and went and bought another one. So it's okay to sell properties. So that's how some of the ways I mitigate my risk. Then I don't know, Chris, if you got any more answers to that or, you
I
know.
guess that I think Chris will follow on to this is you know, looking at cash flow and stress testing. What happens in a position if your interest rates goes up, 1.5%. Or in the cases from a tenant's perspective, from a risk, it's vacant for 6 to 8 weeks, or or the property needs an upgrade.
Yeah.
How would someone would manage those?
See, and that's a very good question because I come across people always getting stressed about interest rates going up. Well, firstly, look at the option. Can you break your interest contract and refix it again? I look at that. I recently did it. I actually did it over the last 2 weeks. I looked at all my QE Bank rates and I was like, geez, they're going to expire in 2 or 3 months. So I started breaking them and they charged me, $700-800. But I've refixed them at 5.3% for 3 years because I don't want any headaches. I don't want to hear any issues. I have the cash flow to meet if interest rates go up to meet that obligation. But I suggest you take 10 minutes out of your life, look at all your interest rate, when are they expiring, contacting the bank or contacting Chris. Chris can go out and do some shopping for you and see what he can come back with, and then fixing your interest rate. Now, in the event, let's say interest rates are going through the roof, and this can happen in this oil war, anything can happen here, or you've got a massive renovation coming up. This is why it's important to have working capital in place. So working capital means your savings, what's in your bank account, cash. What's your overdraft? Do you have access to overdraft? And that's what Chris can organize for you. Do you have offset accounts where you can offset your mortgage with cash? And so you can tap into those kind of cash. Or do you have credit cards that you can access to? And once you've done the repair work, you can repay your credit card. So it's really important that anyone in business, property investing, or even just normal mum and dad with a family home, you have access to some sort of working capital. I, the amount of effort I've put into my working capital, it's taken me nearly 4 years to organize a $5 million working capital between four banks. And Chris was absolutely gobsmacked when he saw what I had, and that's what I have access to funds, and that's really important. So I think working capital, something that I want people to write down today and think about it, that's what's going to help you to grow over the next few years. Now, I also personally think that property prices might be stagnant for the next few years. We might not see an increase. So if people ask me, what should I be buying? Perfect time to make money, perfect time to buy properties is now. So if you are looking at ways of making money in properties, which we'll give you an example of what we do, you got to buy properties discounted. This is really important. If you can buy your properties discounted, you create instant equity, which you're going to get over the next 10 years now. And use the equity, you can refinance and buy more houses. So that's one thing I look for. The other thing I look for is multi-income properties, so they can help me with my cash flow. I look at that, or I just look for cash flow positive properties. That's the kind of stuff that I chase to mitigate some of this cash flow stress testing.
So you're saying to talk to Chris and get a extra fund put aside from the banks available for anything unforeseen?
Mate, if anyone's listening to this presentation, you should be booking a time with Chris or your banker and looking at ways of putting working capital in place now before, if this oil war gets out of control, at least you can control your own cash flow and things like that.
I think just jumping in, boys, as well, is that kind of a think about managing risk. We're going again, even though we thought we're kind of going about to be out of the uncertainty of the last few years, is that managing risk is asking hard questions and stress testing. And so it's looking at your situation, going, let's say you've got a couple of investment properties, going, if they are to be vacant for an extended period of time, can you handle that? If someone is going to, do cause some damage to your property, can you basically handle to basically pay that mortgage without the rent coming in? If that's not the case, do you have adequate, basically, for example, insurance, which will give you a rental cover to provide that side? So look at a lot of people we see can be a bit too gung ho. Property investing is fantastic, sorry, but things do go wrong, and tenants can do a pretty good job of making life difficult at times. So it's not all based as roses. You've got to ask those hard questions going, if something goes wrong, if I'm out of cash flow for a while, and that could be on your personal side, if you get a knock there, basically, can you afford to basically pay your mortgages? And far too many people, especially through the boom times, go through stages where they'll push themselves far too far, won't have any money left over. And suddenly we go through a situation like we have in the last few years where they've got no cash flow and they've got to sell a property at the worst time in the middle of a recession. So make sure you basically build these buffers up over time.
Yeah.
And Sal, earlier you touched on, setting up structure and getting that right. The moment, you're looking at company and trust structures, are investors using the right legal structure? Getting this wrong is expensive. So, like,
Well, yeah.
what do you commonly, what do you see most commonly going wrong?
Well, what I firstly see is like someone wants to buy, let's say, a rental property, just and what they've done is they've gone and got a pre-approval under their personal name. Now, what happens is, they've gone and bought the property, they've gone unconditional, and they've come to us, and we're like, well, hold on, buddy. We recommended, or we are recommending that you go in a company or trust structure. And then we quickly form the structure, and then the banks have to redo the whole thing again. So it's very important that before you go unconditional, you talk to your banks and your accountant as to what structure you should be going into. Now, if you're a cashed up investor, definitely you can park it into a trust. Your assets are protected. Most cash flow investors want asset protection. They don't care about the tax bill, right? And if you're starting into properties, I would suggest going to a company owned by yourself, but if you, like I said, if your cash flow is different, totally different structure, and we can catch up with you and discuss what structure to go through. But yeah, do not make the mistake of going and getting a pre-approval without your structures in place. Not only that, now you've got to rush around and annoy yourself that you've done this, you've also got to annoy your bankers and your lawyers. You know, I, as the accountant, don't care. I get the easy part, right? But the hardest part is the bankers and the lawyers. They actually moan and they get really upset.
And not and the stress for yourself.
And the stress. Oh, absolutely. Absolutely.
I think one thing I'd say as well, boys, is I remember vividly in kind of probably like I think it was 22, we just came out of the peak of 21. And probably in a lot of cases it was kind of looking at it kind of going, it was going to be very hard to buy a property at such a discount to compensate for how overinflated property prices were, if that made sense, because we've gone through a stage where prices were nuts. At the moment, I don't think our property prices are necessarily overall that inflated. I do think some areas are not necessarily going to have that much growth, but there is some kind of good cash flow buyers around the country. And I suppose I was looking at, we were starting to see there actually is more and more investor interest out there. Looking kind of where we saw the investor market get really quiet. I think I was looking at some numbers, and the Reserve Bank keeps some data on who's borrowing money, first home buyers, investors, all this type of stuff here. And basically, the first quarter of this year, there was 14 times the amount of investor money that was borrowed in the whole of 2023. So those investors were coming back before we started to freak out about Iran. So to me, I kind of still look through the Iran situation a bit, keeping in mind that this will be freaking out a lot of people at the moment, and go, if you're a cashed up investor, there's going to be some good deals around in the next while. That's not saying to everyone that they should be getting out there buying. If you're short on cash flow, you need to be careful. But we've seen a lot of people who have been wanting to get pre-approved, get their powder ready. Sal's been telling me all day about his $5 million revolving credit facilities that he wants to where he's trying to find a place to basically, put the money. If you're cashed up, make sure you've got your buying rules in place, because there's going to be some good deals available, because people will freak out. Unfortunately, some people are going to have to sell because the market will slow down for a period of time while everyone freaks out over this.
Mm.
Chris, we know when you said 14%, so in comparison for numbers, do you have that figure right?
So sorry. So I think the stats I was seeing were going back to what I said before. So what happens is the Reserve Bank's got numbers on the total amount of mortgages out there, and the pool of, I suppose, property investment mortgages only grew by $340 million in the whole 2023 calendar year. If that makes sense.
Yeah, 340 million. Yep.
Yep, it grew by 14 times that, or 4.8 billion in the first quarter this year.
Okay, so we were doing well. We were tracking very well.
Yeah, so if we kind of look at what the data was before Iran happened, investors were coming back. Um, but for those of you who are, I suppose, listening before this, Sam rang a mate who I think who was a real estate agent. Was that right,
Yes,
Sam?
yes,
And he was basically kind of mentioning that the traders were back.
yes.
Yeah, and so we're starting to see trading activity. Literally before we got on tonight, I've got a client who flicked through who's a full-time trader, flicked through an agreement. So we weren't seeing that a while ago. We're starting to see that kind of activity coming back. So there's definitely a bit of good old counter-cyclical investing for those of you who are safe, who have got the facilities, who have got the cash flow, who are in a good position. There are some good buys, and there's going to be good buys if you can look through the concerns that are in the market at the moment.
Yeah, and that's what we were talking about, the big equity, you know. If you can buy discounted, you create yourself instant equity. And you know, I've settled a property this week. Then knows about it. We're looking at about $1.5 million margin on it. You know, it's four houses we're going to build and on sell it in a very good street, and that's the kind of numbers we chase. We can talk about it a little bit later, but then you've got more questions for me, or
Yeah, I do. So, I mean, moving from, that leads up next to the next topic that we want to talk about is property prices and demand. So, what's moving and where? So, if I was to ask you, what type of properties are selling, moving?
well, I mean, then you know, we build townhouses and you manage them for us,
Yes.
and one of the things we have is townhouses, and they're actually moving. And the reason they're moving is because first-home buyers are chasing them. And also you've got mum and dads who are living in a three-bedroom cross-lease property, old, and they know it's going to cost 200 grand to renovate. They're moving into townhouses because they can't afford the renovation. And the type of townhouses that are selling are the ones that have good layout, three bedrooms, two toilet bathroom, internal garage, parking outside, giving them two car parks, right? The kind of townhouses that are not selling are the ones there's no parking, because people don't want to park 600 meters down the road, wake up in the morning, they dress up, the kids dress up, they're all dressed up nicely. As they're walking out of the house, they get hammered by rain and cold, and that's what they don't want. To walk 600 meters down, they're wet. They're having to go to school wet. And that's why they're getting out of those properties. So it's very important that, townhouses that are built with car parking, allowing people to park their cars next to their house. The other things that I've seen that's moving in the market are your existing homes in good school zones. They're going out the door. Now, one of the areas that really, really fascinates me is Kelston in West Auckland. I mean, if I take you back 20 years ago, you could buy a property in there for 150 grand on 1,000 square meters. And today, the same property is selling for $1.5–2 million in that area because you've got seven schools. And seven schools, they employ close to 400 to 500 people. And you've got about 5,000 students in that area attending school any time of the day. So it's become a little city of its own. So now the developers are buying properties, they're chopping them up into little units, and they're all getting rented within days. So recently, a guy did 20 units on Archibald Road, built within 2 or 3 days, every family member moved in. Because now they get to move into a brand new house, they get to go to work, the kids just walk around to schools, and it's absolutely amazing for them. So people want to live in those areas. There's parks down the road. They don't need to have parks and things like that. So in good school zones, or there's schools there, you've got seven different types of schools there, and it works for families. Families wake up at 4 in the morning, go to work, knowing their kids are going to go to school safely. Um, I have seen developers buying good sites, all the big sites with services on, they're paying 2021 prices. Fed knows we look for sites, and if we've got an easy site to build on with all the services, I'm happy to pay another 200 grand, because it saves me all the headache that comes with it. And so I look for good sites, and and all the developers are doing the same. So those things are selling. Multi-income properties are selling like hotcakes, because what happens is people buy them, and they move into the first house, they rent the second one to pay their mortgage. It works. Multi-income dwellings work all the time. That's I'll tell you, if you get a chance, buy it. A two-bedroom or even a one-bedroom income is about $500 a week anywhere in the country. A beautiful one bedroom will rent for $500 a week. I had a one bedroom in Rotorua, always rented at $490 a week, always. Never had any issues with it. So multi-income, they always go out the door. Now, you've also got a good property, you've done it up properly, it's in a good area, it will sell like a hotcake, 2021 prices. Those stocks are moving. But the stocks that need to be done up, and I can tell you renovation cost is just going through the roof. Then we buy materials every week, and man, the price of materials is up about 25%, on our pipes and things like that. So I personally think long-term housing prices will stay stagnant. Less people are going to start building houses because the cost of building is up 25%. Your money cost is up. You're going to see less housing getting built. As a result, I think over time, maybe over 5 or 6 years, the new builds are going to go up in price because people will know the cost of building new houses is up 25%.
I'll
You
agree
know?
with that. I mean, I think every other week I get a letter from the supplier saying price increase, price alert, prices
Yeah.
are changing from effective of the state. So yeah, I mean, cost of building it is up. But the other thing is also what it's selling is, vendors are having to meet the market
Yes.
as to, the right price. If they have high expectation, it's going to be stagnant. So yeah, meeting the price of the market is a good important thing. In respect to value, where do you guys see house prices or values rising in which area?
South Island.
Yep, we see South Island going through the roof, and part of the reason I started studying South Island over the last 10 days is the massive infrastructure work that's been getting done there. You had the stadium built. There's other stuff getting done. The roadings are getting done. It's a bit of money being spent. The tourists are ending up in South Island. The amount of tourists somehow, I don't know what's happened around the world, but we see less tourists in North Island and more heading off to South Island. I don't know what's happened, but it's happening.
I was at the Auckland Property Investors event at the start of the year, and a guy mentioned, I'm going to get my numbers wrong on this, but it was something apparently like 90% of all the private jets are going straight to Queenstown. They're not going to Auckland anymore. And there were
Right.
people in the room at that stage who owned some like high-end boutique accommodation, and they said, "Yeah, we're missing all of it." Apparently, Auckland's just been bypassed, and it's just going straight down there. So especially a lot of it, there's so much money in Oz who are just kind of going, "Well, why would we go to Auckland?" I mean, I love Auckland's fantastic from a business point of view and stuff like this, but if I'm coming from Aussie, I'd probably go to Queenstown over Auckland myself.
Oh, I'll stone you to death there, Chris. I love Auckland. Come on, you can't talk bad things about Auckland. You know,
Well, in
I
New Zealand, we don't do stoning here.
I know. Well, I tell you, I'm a big fan of Auckland. I traveled to different parts of the city world in different cities, man. I think Auckland does stack up there. Traffic is manageable. We moan about traffic, but man, when you travel to other cities, you realize we have no traffic here. Nothing. We can happily listen to our music and no one's going to annoy us. Um, well, I agree with Chris. I see South Island is where the massive increase is. I personally, and then my numbers, Chris, my numbers. I personally make money more in Auckland by buying properties, the right development site, building houses, creating my own equity. I've learned how to do that, and that's what I want to do for the rest of my life. I've kind of stepped back buying properties that are 100 or 200 grand discounted because I can make more money with building new houses. And I'm now building standalone houses, and that's what I'm going to build. I enjoy building, and Thens knows that. He's seen my stress and yelling and screaming on
You
sites.
enjoy it because you sit in the office and I'm on the ground.
Yeah, Then has to run around.
Do you guys have any? Don't want to turn this into a tech chat, but do you guys have any opinions on? Obviously, there's a lot of AI chat and all this stuff going around at the moment. Uh, I look at even something like COVID, where what COVID did to an extent was people who previously had to be in main centres to work for big corporates were given the ability to work from home. So a lot of them, we saw people move around the country, if that makes sense.
Mm.
As big corporates suddenly gave people more freedom. With some of the AI stuff coming out, is there a chance that continues? If you understand what I'm saying,
Yeah, I
could
think
we have a situation where there's a lot of beautiful places in New Zealand where there's people who sit there and go, I can live somewhere which is more affordable, it's got maybe a bit better lifestyle, all this type of situation. I don't need to get stuck in the traffic for an hour to work each day. And suddenly that means the big cities, traditionally what's happened, from my understanding, is we go into a recession, people lose jobs, and they're driven to the main centres to find employment. That's not necessarily happened in the last,
Mm.
if that makes sense. We're seeing probably our two dominant centres, excuse me, to Christchurch, kind of in regards to Auckland and Wellington, who have been absolutely pummeled. Christchurch is going fantastic. South Island's going fantastic. People have moved around the country and stuff like this. And I just wonder if there's more of a movement to tech and AI over time, if that might continue.
I
Well,
mean,
I personally agree with you there, Chris. I think, over time people are going to look at affordability and obviously move to different places. And I think what you got to remember in 2007, 8, when we had, um, the people lose jobs in small towns, they were moving into bigger towns for jobs. Now, back then, the rent in Auckland was, say, $700 a week. But in Rotorua, the rent was $250 a week, right?
Yeah.
Right. But so people came here, got a job, paid their rent, right? But now what we see is the rent in Rotorua is $700 a week. The rent in Auckland is $700 a week. So people are going, well, hold on. Firstly, what we can do is either go back on benefit because we can pay our rent, right? Or they can go and get a high paying job. Now, I can tell you this now, there's more employment in smaller towns than Auckland.
I think there's definitely more structural unemployment in the cities at the
Yes.
moment.
Yes. And to give you an example, I one of my clients rang a plumber in Rotorua to fix the shower tap. And 2 weeks later, he rang the plumber and said, "Where's your invoice?" The plumber said, "Mate, you're on 3 weeks waiting time." You know, I rang an electrician in Rotorua to go and fix a stove. They said, "No, you're 4 weeks away. We're 4 weeks booked up." So I had to send an electrician from Auckland to Rotorua to fix. It's insane. You cannot get working or tradies in small towns. They're just not available. So I think we need to be careful how we compare different towns. But I think one of the things this country will face is good tradies. And in Auckland as well, it's hard to find good tradies. Well, Thin and I hunt every day, and half of them will say, yeah, they're on site working. When we show up, they're not. They're missing. So, and having to call them 500 times in a day. So, got to watch all that.
There definitely feels like there's a story of two islands. So I remember even back into last year, I
Yeah,
think it might have been start of December,
yeah,
a chat with you guys on an
yeah,
evening. I was actually in Christchurch at the time,
yeah,
talking with a real estate company basically down there. And at that stage of the year, like Auckland's still pretty depressed in some ways, even though we'd had a better year.
yeah,
Some of the Cantabs down there, they were sitting there going, we've not even had a recession as far as we're concerned from a property point of view. And it
yeah,
feels like even the further you go south, the better the mood is down there.
yeah. Now, Thin, I think we're going to go a little bit faster because I think we've just gone past our time.
okay, cool.
And then we can
I'll
answer
s-
some questions.
Yeah, so people, if you've got questions, put them in the Q&A section. But what I'm going to do is I'm going to incorporate this question from Max into your next question that I'm about to ask, Al. So Max is asking, what would you say are the sign of a good deal when it comes to negotiating a house? And the question I have for you is, what sort of properties would you buy? So if you were to look at what sort of properties you buy, and how do you look at them as a sign of it's a good deal when it comes to negotiating?
Oh, well, firstly, I look at if I'm just buying a rental property, it has to be cash flow positive, right? Number one, is the rent going to cover all the outgoings, including the principal payment? Yes, tick. Then I'm going to say my next part to look at it, is it discounted? Am I buying something that has equity, right? If it does, tick. Now that's if I'm buying a rental. Now, if the property has a bigger piece of land, I look at that as well. Because in my head, I'm trying to work out how many more dwellings I can build. Or, can I build some new dwellings at the back, sell the front one away? Because I don't want to own an old house. I want to own all the new ones. That's what I'll do. Now, it doesn't mean I'm going to do the development straight away. I'll park it for 10 years and look at it later. But I do like land banking.
Cool, cool, cool. So, I guess that was pretty much on property buying and so forth. I mean, want to talk about trading, trading property. Is that right for
Yeah.
you? I guess it's more of
Oh,
my.
yes. Yes, then. Yeah, that's your cup of tea. So let's talk about trading properties, and probably Chris can give us a hand with this. So, I mean, guys, you're listening to us talk, but Then is a very experienced property trader. Him and Maggie, they've done a lot of property trading. They've helped a lot of people over time. Now, then, you know, what does property trading mean in practice? Like, a lot of people hear that. What does it mean?
So, property trading is in practice really about buying with a clear strategy to add value and resell for a profit. That could be through renovation, subdivision development, or even solving a problem that the market has overlooked. An example of that of a property that does not have consents or CCC. So a lot of people think it's just about buying cheap and selling high, but the reality there's more involved behind the scene. Due diligence, managing trades, council approval, timelines, finance costs, and understanding, your end market. For personally for me, I look at trading as an active business, not as passive investing. You need a system, reliable people around you, and the ability to make quick decisions and managing risk. So the profit is made when you buy correctly and through group project management and execution. But if you get either one of those wrong, the deal can turn real badly.
Yeah, and I think then you nailed it by saying that's the most important word then used is saying you're buying it correctly. In trading, you make property on the day you buy it, not when you sell it, because you bought it correctly, right? Let's say in the event you haven't bought it correctly, you can offload the property because someone else might be chasing a smaller margin. Sell
Mhm.
it to them, move on. They're happy with making 10 or 15 grand. Let them do the trade. Um, then is trading properties right for you? Like, say, trading requires a lot of capital, and a lot of skills, right? Is it the right thing for a lot of investors to do? Or is it good for passive income? Because you became a full-time property trader. So,
Yeah,
yeah.
I mean, personally, property trading is a great opportunity, but it's not definitely for everyone. There's a lot of hard work goes behind it. A lot of people see the end result, they see the renovated property or what it's sold for, but they don't always see the pressure behind it. Like you said, you need the capital, you need to understand the numbers and know how to actively manage risk and uncertainties because there are things that you will see once you open a war that you never got to see part of your due diligence. Um, but the other important point is that it is not passive income, so it's active. You're solving everyday problem, managing contracts, dealing with banks, councils, timelines, and unexpected issues. So, you know, I always tell people start small, learn the process, understand your market. Don't purely rely on social media success stories because good trading is actually quite disciplined and number driven.
Absolutely. Do not rely on social media. I do not make my investment decisions reading on what the Herald reporter is saying. If the Herald reporter is the experienced property investor, can show me they've got a good portfolio, I would listen to them. And to be honest, I've never found a reporter that has a good portfolio. They're just basically making it up on the day. So do not listen to them.
Most of them
Then
don't.
what?
Most of them don't own property.
Yeah, they don't even own property. They rent, so that just shows you what their knowledge are at. And I watch the news now and then. I have guys talk about shares. They're telling people to put money into shares. Now, I don't have a thing with anything wrong with shares, but I've met more people losing money in shares than making money in shares. And I've met the same more people losing in Bitcoins than making money. Now, with properties, I'll probably meet one person every couple of years who's done something wrong and lost money, right? Properties actually work really well because you're forced to save money, you're forced to pay off debt, and a couple of years later you realize you don't want to sell it. I've got a client which I'm meeting him in the next couple of weeks, I think, and he thinks he bought some bad properties, and we discussed a few years ago not to sell it, and then we discussed a few weeks ago, and he said he's not selling them. They're great properties now. So it takes time. It comes right. So be careful with what you do. Um, Then, what property deals are you working on right now? And what does a good, trading deal look like versus a bad one? And tell us a bit of that.
So at the moment, I'm more involved in residential development, so overseeing the development project so more like adding value through planning, construction, and project management. But for me, a good trade is a deal where the numbers work, even if things don't go perfectly. So always build a buffer for construction costs. So if it's renovation cost, finance cost, delays in soften resale values. So, you don't overestimate what the property is going to sell for. You just have a low price, medium price, and high price. But even at the low sell price, you are still making a profit. So if the project works perfectly and the numbers add up, that's when we go forward with the deal, and that's a great deal. Bad deal is is simply overpaying at the start, underestimating renovation cost or development cost, and heavily relying on future market growth for your profit. Because when a market is stagnant, uh, you know if you overpaid for it, it's not gonna uh, make you any more money.
Mm.
So the due diligence process is quite detailed now. First I look at locations and demands, who is the end buyer, um, and then check planning, zoning rules, services, drainage, overlay, and most importantly, market value, assessing what a property is worth in its current condition. Once we added value, what is worth, so that we could work those numbers backwards so that it's profitable. And if it doesn't, or if it's too tight of a margin, we would not go with the deal. But this is something that I could spend hours talking about because there's more to it. But you got to be thorough with the
Don't do that
process.
then.
Yeah, no,
You know.
I won't.
I
But
need to go to bed. You know.
but yeah, that's it. I mean, it takes a lot of practice. And you got to understand the numbers and have confidence in executing it.
Yeah. Now, I also want to add something really important, guys. Property trading means you have to be GST registered. So if you are doing property trading, please do not do it in your own name. Please do not do it in an entity that owns your family home or your investment properties. What you got to do is set up a separate company and you do trading properties out of that. Now, the biggest thing you got to watch out for GST. If you don't understand GST, get accountants like GRH to have a look at it. It takes us 15 to 20 minutes to review and give you a GST opinion, right? And that will save you a couple of $100,000. So very important to talk to us. And you've got, if you do property dealings, you want to have access to people like Maggie and Then and Chris as well, because they can organize your funding and any other issues that you might have or help you with the DD process. I'm all up for trading. I like trading, but I'm more focused on building brand new houses at the moment. I'm kind of enjoying that process. Now, we're going to finish the presentation now, guys, and we're going to start answering questions. So please have your questions coming through. Sorry, we've probably gone up by 25 minutes. We shouldn't have done that, and we do apologize. But we'll now step back and answer your questions. You got three guys sitting here. We are probably about $1,500 an hour here, guys. So throw your questions and we'll start answering them. Then what have you got?
So Peter says we're not far away from an election, and good, God forbid, Labour gets across the line. So what does the panel feel about property investing game might look like as a consequence of this change? All the risks that you are currently talking about could change significantly.
Oh, that's if Labour gets in.
Yes.
Well, if Labour gets in, I've thought this through in my head and I've spent time arguing with people as well. And I have to really had to put my left brain on, because I'm not a lefty. But I can tell you, if Labour gets in, I'm going to run and buy as many properties as I can. Because when Labour comes in, there's one thing they do right, which I think National does it wrong, is Labour provides housing for vulnerable people, right? They sign up lease agreements for long term to make sure vulnerable people have housing, right? And which I think is fantastic because we need to give people housing because we need the young generation, the kids, to have good housing to come up the chain. I used to be just like anyone else, far right, believing, well, who cares about these people? If they don't want to be helped, that's their problem. But it's not about them, it's about the kids. And something Labor did well, and I watched that, happen, you know, before National came in. They provided housing and kids were more safer. Kids had good clothing, food, access to water, and go to school. Now kids are running around streets homeless. I have heard rumors that there are about 400 homeless kids in Auckland at the moment. And this is again, we haven't provided housing, and this becomes our problem later in the years because they're not. been provided houses, so we then have to provide them other social services to put them into housing. So we might as well start fixing it now.
Can I give the conflicting opinion to that?
Hey, go for it. I was waiting for that.
We need a little bit of political debate on here. So
Yeah.
I'm a voracious reader, and hey Pete, I hope you're going well, by the way. And was a very big fan of the late great Bob Jones, and so I read pretty much all his property books and a lot of his other stuff that he came out with, and I think he analysed both. I don't think he was actually a great fan of either Labor or National over time. I think he actually voted for Labor a few times over several elections. He is correct that National is pretty boring. They don't actually do anything. What they tend to do is basically wait for Labor to stuff up the economy, which they seem to do most times. And then what they'll do is they'll come in and they'll almost do nothing for basically a period of time. And that might sound like quite a harsh judge on their expertise, but if you actually go back and look at that over a period of time, they don't tend to do too much. They tend to pull back some of the expenditure that Labor's maybe done, tighten the belts, and try and basically clean up some of the mess that basically Labor's made. But Bob did a great, I suppose, review on multiple cycles of Labor and National. And what tends to happen is Labor came in, and you'll find the property market tends to go nuts for a period of time. If you look at most graphs, you'll see the property prices are actually going up more through times where Labor is in power than when National are. And that's generally because it flows through, just like, as I said, Labor will come in, they'll spend up a storm. Some of that may be the way that Sal was just mentioning there, which is basically giving money to people. But when you're giving money out, basically that generally flows through the economy. People feel better and they basically start spending more money. But basically, eventually someone's got to pay the piper. And that's what does tend to happen with Labor over time, is that they cause a bit of an economic mess, as what we saw previously, and National will have to come along and clean it up. And I think if we look at who's basically running Labor, he's the same person who basically has who alongside Grant Robinson and Jacinda and stuff. But in my opinion, got us in the mess last time. I think it would be a disaster for him to get in. Politically, however, I don't know enough about things like the tax policies and stuff like this. I'm more concerned of who Labor would bring into Parliament in regards to the Greens and the Maori Party and some of the very left-wing, I will call communist policies that they would want to basically bring in as well. And I think that what we're going to probably see either way, whether it's the left or the right get in, they're going to have to give the minor parties a lot of concessions to get in, because the major parties are actually getting lower voting blocks than what they used to previously. So, I mean, that's another reason why personally I would like to see the Iran war situation over and done with, because I think what happens is people do tend to vote for the incumbents often if they're feeling better financially. When people aren't feeling good, that's when they start to vote incumbent governments out. And I honestly think behind the scenes, the Nats and Luxon's plan was for this year to be a lot better, green shoots to come through, which have been happening in the economy. And I think, unfortunately, what's happening is that this elephant in the room, which is Iran and the US, and what's going on between them, is kind of stormed into the room. And that's probably upsetting the apple cart and may have a pretty big influence on the election.
Malcolm says this has been the most experienced presentation I've ever attended. Well done, guys. I've settled on my ninth property and looking at buying another discounted and develop another. So well done to you, Malcolm. Linda asks, what type of properties are you building to have cash flow positive?
So we're building basically 2-bedroom houses, and we're renting them out. So and basically to make them cash flow positive, you got to buy the land at the right price. If you buy a good development site with resource consent, building consent for $1 million, let's say you're building 8 units in there, that will be cash flow positive. Now, the only thing I'm going to tell you, Linda, you got to watch out is the property material price. Those are going through the roof. So what I've done to be more careful with my build cost is I've dropped down to one project at a time now. Instead of running 3 or 4 projects, I'm running one at a time, hoping material prices will come down once this war thing gets under control, which means I'll be able to build houses much cheaper. That's what I'm hoping. I'm guessing that they will come right, but you just got to watch for your material cost. That's the biggest cost that I'm keeping an eye on so far. But yeah, we're building cash flow positive properties. I'm buying cash flow multi-income dwellings as well. So we drive around Auckland, and if we find good ones, we grab them. Mm.
Jackson's asked, what you said about buying a property through a company or trust, etc. How does that relate to a first home buyer? Brackets use KiwiSaver transitioning into those structures.
So if you've already bought your first home in your own name because you've used KiwiSaver, what you got to do is wait, I presume, 6 months, Chris, am I right? Before you can move the house into a trust.
Sorry, Sal, say that again. So
So if you've used
oh,
KiwiSaver to
so
buy,
sorry, there's never been a fixed rule, right? So I think KiwiSaver providers, government have never come out and said this. The unwritten rule is 100% what Sal said. Everyone seems to say 6 months, but I've never actually heard a formal rule. But that seems to be, yeah,
yeah,
let's get behind the scenes.
Someone's offered their service, so thank you, Michael. Let me know if you need a good electrician. Yep, definitely. Yeah,
please
send us an email,
email.
and we will yeah, see what we could do. We're always looking for good people. Ben's asked, how do you think the proposed building warranty will affect this long term? Initially, it will be cheap, but feels like that's a foot in the door that will be swing open wide. Thoughts?
Now, I don't know what this new building warranty thing is, to be honest. What is it? Do you guys know?
Is it referring to having insurance for a developer who builds it so that you know the risk stays with them for X amount of years and they have insurance covering for if there's any building defects?
Yeah, I think you've when you build brand new houses, you've got 10 years to come back at a developer. But if there's issues with it, it goes back to the council.
Yeah,
Um,
so they're pushing that to have your own insurance to cover for it so that the
right.
insurance takes liability for
Yeah. Well, Ben, we build good houses, so we stand by our quality. If there's issues, I send them to Thin to fix it.
it.
So,
Mike
but
says,
something I need to look at later. Yeah.
Mike says, how do you evaluate and then track properties for both hold and trade?
Well, Mike, firstly, what you got to do is look at your cash flow, your business cash flow, your employment cash flow. If you got enough cash flow coming in and you're doing well and you're busy with your job and your employment, I suggest you focus on building up whole properties. Don't worry about trades because trades are extremely time consuming. Now, if you do have spare time and you go, no, I want to do some trades, you will know which properties to sell. You will know which properties to keep. The trade that actually works in this market is the one that's done up, say on 400 meters squared side or maybe less. Um, 3 bedroom, you turn it up and you can sell it for 850, 900 grand. They go out the door like hotcakes, isn't it then?
Yeah.
You know, and if you can show there's more than two parking, people like that. People are looking for parking space now. It's in big demand.
And from a valuation perspective, or how you evaluate it, it's just you know, you got to do the numbers, do the whole scenario. What is growth? What sort of gain you're getting from adding the value? What's the rental
Yeah.
income? All that cost, so that then you could look at it going, hey, is it worth a property to hold on to, or is it something that I could trade? I mean, I'm just speaking hypothetically here, not specifically to someone. And that's how you evaluate whether it's something that you could hold on to, or actually can you make a decent profit by able to add value and sell it.
Yeah, there's no point holding on to the property if you're making 40 grand equity. You just
Mhm.
try, for that sake, just sell it and move on. Now, guys, before we answer any more questions, you can see the QR code at the back. Please, if you can fill that out, if you'd like an appointment with GRA or Chris or Than or Maggie, please fill that out and we'll get you an appointment in. The quicker you fill it out, the quicker we can get you appointments. We do get filled up. So please fill it out, and I just don't want you to be disappointed if you book 3 weeks later. If you can fill it out ASAP, we'll get you into appointments.
Peter asked, can you tell a bit more about what are the rules around bright lines for developers?
Well, my friend Peter, if you're developing to sell, Brightline doesn't apply to you because you got to pay tax anyway. Brightline applies to people who are buying properties as a hold and selling it within 2 years. It applies to those investors. But as a developer, it doesn't matter if I sell my property in 2 years or in 4 years, I've still got to pay tax. Or in 10 years' time, I've still got to pay tax on that profit. So they're totally two different things. So Brightline is designed to capture property investors who are not GST registered, who are not trading, but they end up selling within 2 years for whatever reason, and they make a profit.
Michael asks, how can you trust a social housing provider to have the fund to make good your properties at the end of the lease? One can imagine scenarios, e.g., if Labour moved social housing to a public sphere where the funding to these organizations runs out.
Well, what you got to remember is when you get a chip provider, so they're called chip providers, they are funded by the government. So the government has to fund them, whatever happens, right? And this chip providers not only provide social housing, they provide social housing for people who are disadvantaged in a lot of ways that you and us can't think of, right? Disability, right? Family violence, right? There's stuff like that. There's kids in protection, you know. We got to have the services. Doesn't matter if the country has money or not. You got to protect these people. So social housing is part of our life, and it doesn't matter. Like I said, I'm not a lefty. We have to protect these people. We have to protect it. Otherwise, the cost is more if something happens to these people, right? So we're going to continue providing social housing. Now, I'll tell you this: under Labor, the social housing providers were probably more funded in terms of the care, the responsibility, and making the house good again. Nowadays, under National, we've got some insurance companies that can look after you. There's a company called Gallagher Insurance. They have designed products to protect your house from social housing damages. So for a couple of $100 more a year, you could get insurance like that. And that's what we've done. We've just put more insurance in place to protect our assets. I love social housing. There's nothing wrong with social housing tenants because if you didn't have social housing, they'll be just called WINS tenants. The name just changes. They're beautiful people. They just don't have the advantage of getting into homes. And so once you can help them, they're good. I've never had bad experience with social housing.
And you also have contracts in place, right, Sal?
You have contracts in place. You've got to have contracts in place.
Mhm. Question to Chris from Lera. Could you please repeat the name of the author of the books about properties?
I'm presuming that was
Bob
for
Jones.
Bob Jones. So Sir Bob Jones. So I need to make clear, I didn't necessarily agree with everything Bob Jones said. He was pretty controversial, but he died last year with a portfolio of about $2 billion of property. So he knew a thing or two about investing.
Yeah.
Gillian
And
asks, sorry, you going to say something, Phil?
and you got to remember he was investing for nearly 60 years.
That's the part I
And
think that was so valuable, Sal, is that this is a guy who went through the ups and downs, like I think Peter was asking great questions before. Yeah, but you're dealing with a guy who's seen so much. So Bob Jones was. We spent a lot of this presentation talking about Iran. Some of you may not know that we went through a situation in Iran in the early 70s with a massive oil crisis, which caused massive inflationary issues and stuff like this. Bob built his wealth through that kind of market. So you're talking about a guy who, by the time he wrote his property books, he probably had 4, 5, maybe 6 decades of property investing experience.
So you're coming out with the book soon, Chris?
I won't compete with Mr. Gilligan's book. I still think that's a fantastic book.
Gillian asks, how much how much how much does it cost to create a new title from the original site? For example, there is a site to create 6 new titles. Um,
well,
obviously,
I'd probably say, and back me up on this, I'd
yes,
probably say if you're creating 6 new titles, your driveway, your building consent, your resource consent, probably looking at 250 to 300 grand.
you're looking at vector connection, water
Mm.
care, chorus, but then also looking at where in New Zealand because
Yeah,
it
yeah,
fluctuate too. So
yeah,
yeah, that'd be right.
yeah. If you start with 300 as your minimum, I think you'll be safe.
Mm. Kamal, there seems to be a lot of noise over the ditch around new tax law around owning properties in Australia. Will we see anything similar making its way here?
Um, to be honest, if National stays in power, I don't think there's major changes coming. If Labor gets in, they're talking about some major changes. But Labor actually have learned their lesson by making interest non-deductible. So the cost of rent go through the roof because what all the landlords did, they just passed it on. Today alone, I just had a property rent increase by 19% out of Auckland. One increase, 19%. I just had that confirmation come in this evening. So what you got to be careful is if you kill the investors, the private investors, who are people like me going out there building houses, we work 7 days a week. We don't stop working. Sunday doesn't mean we stop working. We're on sites, we're looking at our numbers, we're organizing our Monday and what we're going to do. So you're going to kill people like me out of the market. The number of houses will just drop, which means rent's going to go up. That's what happens.
Michael asks, given the Green Party's policy on wealth tax or on trust, would you still buy a private resident in a trust today, or would you buy in your personal name?
Well, we don't know, Michael, exactly what their wordings are. We got to read their wordings because, family homes could be exempt. I understand. And there's other assets that could be exempt. I mean, people usually use company structures, and stuff like that to safeguard their assets or limited partnership structures. But we need to know the wordings to exactly give you that answer. And they don't have any wordings of this because all they're making is noise.
Yeah.
Yeah.
Rohan asks, what cap rate would you consider as cash flow positive? I mean, comes down to cap rate, it's location, type of properties.
Well, I prefer like minimum. I would probably go 8%, and then I prefer 10% as my return. 10% is what I'm comfortable with. And that's what I'm negotiating with most of the big properties now. 10% return because your rates are going up, your insurances are going up, and with the interest rate fluctuating the way it is, you want to be sitting in a comfortable position and you want to be able to provide the houses.
I think what Sal just said is actually really important is that spoke about inflation a lot earlier on in this presentation. And two of the costs, and I'm not just talking about property here, but across everything that have been going up have been insurance and rates. They've been going up at a massive rate over the last 5 or so years.
Mm.
Just backing on to Julian's question earlier on title, she goes, you mean per title?
No, for the whole six title, because you're doing six at the same time. So you got a resource concern, your building concern, your driveway, everything costs roughly 250 300 grand for the six.
Kamal asks, is our RC facility revolving credit facility considered working capital? We're assessed asset rich, cash poor, with a healthy revolving credit facility, and just waiting for the right time to sell off some of our properties to pay off debt.
Oh, and looks like Carmel, looks like you are retiring from the game now. Perfect. I was hoping someone would say that. Something I've learned over the last 20 years when I was in my early 20s, now I'm an old man, 42 years old, and in the last 20 years, what I've seen happen is my clients that were in their 40s are now in their 60s,
Yeah.
you
Yeah.
know, and you've grown kind of older with your clients. And I totally agree. You should be selling if you're coming into your 60s to reduce some of your debt level down because the golden rule of owning properties, you buy 10 properties now, you hold it for 10 or 15 years, you sell five and you make five freehold. So yes, I would offload, and yes, revolving credit is working capital, and there's no harm in spending some of your revolving credit if you've got good assets in place because you can sell down and pay off your revolving credit. So yeah, I would probably start off selling some of the assets, no harm in that. If you're really going to retirement or giving up your job, but have few because they're entertaining. There's nothing wrong with that.
If I can quickly jump in on that, Sal, and it's been quite nuts. Obviously, working with Sal for the best part of 20 years is we're starting to see a lot of clients retire, but we're also starting to deal with a lot of the kids of clients and things like that. But I would sit there and say too many people retire and then come ask questions after. And so they've given up their incomes and suddenly the ability to restructure to put them in the best position possible for what should be the rest of their life becomes very difficult. So if you kind of come into the end of your working life, but you've still got those incomes, come have a chat first with Sal, with myself, with Than, all these type of things, because that's when you can still restructure to set yourself up for the best possible way long term. There's been a lot of rule changes And so a lot of you might go, oh, we're not investing anymore, so we don't need to have those chats. Right now, more than anything, there's been so many rule changes in the last few years. You need to do that before you give up your incomes.
Absolutely, absolutely. And look, when before you give up your job, we could put like overdraft facilities, offset accounts, just give you, loads of cash available to you because then you don't have to worry about money for the next 15 or 20 years of your life, so we can settle that up. But yeah, come and check to us before you make the big decisions.
Chris, this will be for you. Ron's asking, do you see interest rates at 10% plus like in the 70s and 80s, early 80s?
Just to ski, right, Rohan, they were there a lot more recent than that. When me and Sal first met, we
Yeah.
had floating rates at 11%.
Yep.
So that was probably kind of in the middle of the GFC. I think you'll find,
2008, 9, 10,
yeah, we had
11.
floating rates
Yeah.
nudging 11 then. I think you'll
Yeah.
find 70s and 80s. I think they were
Yeah.
nudging closer to 20%. So, but to answer your question, I don't think so.
But
I
it can happen
yeah,
if the oil
I
war
think
gets out of
I'd
control.
be naive to sit there and say it can't happen. I
Yeah.
think the reason I don't think it will happen is we had the economy on its knees at seven with interest rates at 7%.
Yeah.
Right. So people were really struggling. We were probably collapsing the economy then. So I'd be shocked if we got that high because the Reserve Bank won't have to get that high to literally crush everything, to crush inflation, put it that way.
Yeah. And,
I guess what regions are you guys investing in?
oh, Nicola, she's a good friend of ours. Chris, you know Nicola as well, Nicola Evans. Yeah. Very good lady. I have a lot of time for Nicola. Um, Basically the regions we're investing in at the moment is more in Auckland and Rotorua. We thought about going to Whangarei. We just don't have the manpower to go there. But yeah, Auckland and Rotorua is where we are at the moment. I do have a few properties in Wanganui and some in Wellington, but my headspace is more in Auckland at the moment due to the margins I'm looking at with the development sites we are making. That's where I want to be now because I worked out making close to 1.5 to $2 million a year in equity, and I like it, you know. And Then knows I like it, right? Then
Yeah.
I take it out on Then. I
No,
haven't
but
showed you the numbers, Chris, yet, but that's what we're making on equity.
yeah, I'm planning to look at the South Island. I've got a daughter down in Dunedin at the moment, and I'm in the process of looking at divesting some stuff out of Auckland and down into the South Island. I'm actually catching up with a mate of Sal of mine tomorrow to look at maybe kind of considering whether I sell out some property here and reallocate the cash down south.
Yeah.
Adrian asks, what is your opinion on joining up with 2 to 3 partners to do a properties trading? So like a joint venture. If it's a good idea, how or who do I talk to set up the company in terms of partnership, etc.?
Well, Adrian, I'm probably one of the best guys at this. I've done this all my life. I've always teamed up with my mates and we've done JVs all our life and we've made it quite big. So please organize a meeting with us or any of the consultants at GR8. We can help you through the right structure and what you need in place. But I'm all up for JV. I think if you've got syndicate investing with you, your life becomes easy because you've got three brains working or four brains working instead of one. And when you have only one brain working, it's quite dangerous, So it's good to have the rest helping
Glad we got 3 working today.
you.
Um,
Yeah.
last question. Do you think property prices will still double every 10 years, or are those times behind us? Lira asked.
This is my honest opinion, and I've said it earlier in the presentation. I don't think we're going to see increase in property prices. I think it will stay stagnant, right? It will stay stagnant for a while. But here's a but. If you build houses in good areas, they're selling for top dollars, right? And we're talking about more than 2021 prices. Good areas, good school zones, right? You're getting good prices, but you kind of have to make your own equity. You can't go into this top area, pay the top dollar, thinking in 10 years you paid 3 million, it's going to be 6 million. I can't see that happening, you know? So that's why I'm saying you kind of have to make your own equity. What you want to do is go into these areas where the property's worth 3 million, try and pick it up for 2.6 in this market. Make yourself 400 grand equity, and that's what I'll be aiming for. But you don't know, right? If there's a massive war as well, I can see a lot of people moving back to NZ. Just having the attacked in Middle East, where Iran started attacking every other country, I saw a lot of Kiwis rushing back in numbers, and that can happen tomorrow. We can see that happening tomorrow. That's what my belief is. Chris, what do you think?
I 100% agree with Sal. I think some of us have been lucky enough to live through a perfect storm over the last 20 or so years. I think just if we look at where things have gone politically, I think if we look at the way I've said to a lot of people is we went through a situation where, with my bias finance hat on in the 2000s, we went through a stage that if you had a pulse, you could get money. And so there was so much money around that kind of drove the property market. And then in the 2010 plus market, we went through a stage where interest rates dropped so much that drove property prices again because the cost of capital got so cheap. I think politically, the average man on the street's not as in favour of property prices continuing to go up at that rate. So I think we're unlikely to see it. I think the part which is good though is I think this is actually back to what I call good old school proper investing. People stopped investing and they started speculating. So they bought a house and hoped it went up rather than doing what Than and Salesh were saying earlier, where they looked at what the market was and made sure they bought it well under value, which is proper investing and making sure the numbers stack up, even if the property values don't change over time. That's real investing, if that makes sense. So I think we're kind of going back to what I call a proper investment market rather than people to speculate, but buying a property and just hoping that will go up over time.
Yep. Fantastic. Now, guys, we've come to the end of the presentation. So please, when you get a chance, fill out that form. We'll get you in for initial meetings, and also we'll get you in meetings with Chris. Chris is your man for funding. So make sure you chase Chris for free money. Make it his problem. Make it his problem.
Don't sue me.
Yeah, and Than and Maggie are very detailed, informed property investors. So, in terms of if you are doing a DD, you're wanting to buy something, feel free to run it past them. If you have any complicated matters, like if you need help, feel free to reach out to me or Matthew Gilligan. We're happy to help, or one of our senior consultants. Um, the reason we present and we do all this presentation is because we like to share ideas and we listen to our clients, we listen to our audience, what they want, and hopefully every couple of months or every month we can do one of this presentation and make it more exciting for you. Watch out for the next one. We'll come up with something different to talk about, and we'll make it happen.
Thank you, everyone.
Thank you.
Thank you. And
Good
Vivian
night.
and Nicola
Bye.
says thank you guys for the great feedback and advice and information. So
Thank you, Nicola.
Thank you.
thank you guys.
Bye.
Good night.
Bye.